Let's move on though. We're going to bring in Chris Conway, who joins us live from our Melbourne studio. He's from the Australian Stock Report there. Chris, great to see you as always, and thank you for joining us. Now, just take us through what you're making of this session. We seem to be in a bit of a lull period, a seasonally weak period, as we've been discussing sort of recently. The Aussie market, though, remaining really range-bound at the moment.
Good afternoon, Leanne. Good afternoon, gents. Yeah, look, I totally agree. We are range-bound at the moment. We're sort of hovering between 57 and 5,800 and in fairly directionless fashion, I might add. I think, investors and traders are rightly asking themselves what the next leg might be, and with pressure on the banks and the iron ore price coming off, and obviously therefore pressure on the miners, one wouldn't be surprised to see a break lower, below that 5,700 region. And probably would be a good shakeout if we move down to 5,600. It'll shake out all the weak money and the weak players, and worst case scenario, hopefully the Bulls can build a base of support there and launch the next attack higher.
Yeah, well, I mean, just speaking of some of those levels, do you think there's any way of knowing which way the index might break or what the next catalyst might be?
Leanne, you've heard me say on the show many times before when I've been bullish or bearish, and right now I've got the least firm idea of, as I said, which way I think the market might break. As I think it was Martin said, with Moody's downgrading everything and further pressure on the banks today, I think it's going to be the top end of town that we need to focus on, and that top end of town right now is taking us lower, as I said. So, like I said, balance of probabilities. I think, today at the very least, what we know right now, the probabilities lie with a break lower. But, as we've seen with this market in the last couple of weeks, things can change very quickly. Like I said, I'm the least convinced about this market right now than I have been for quite some time.
Rudy, just a thought from you, given the ongoing pressure on the banks and the weakness in iron ore, do you think the bias is to the downside?
No, I actually disagree. I mean, the index is only important for journalists and for fund managers. Yeah? Everyone has a portfolio, you would assume. Everyone owns shares. If you're not overweight on banks, you should be happy these days, because if the index goes to 6,000, you couldn't care less. If you own the other stocks that are going up, and they've been going up now for weeks, why would you be worried that the index is going to 5,600? And with the banks, I'm assuming at some stage, I mean, banks have come off quite a lot, including the dividends they paid out. A quick guess of my end is that the reason why ANZ has outperformed the other ones is that it fell first and deeper. At some stage, surely that the downside will be protected, because I mean, you have to take a very dark view on those dividends. I mean, having said so, and I've said this earlier, I do believe that banks now are in a negative news cycle. That's not going to disappear anytime soon. And I actually think we should switch to Martin here, because he actually published a very interesting chart this morning about the relationship between house price advances and share prices in banks. And if Martin's chart is anything to go by, then the banks are definitely in for a difficult time.
And of course, they're such well-run businesses, aren't they? I mean, despite all of this negative news, as you say.
I would disagree on that.
Okay, would you?
If my business was run like a bank, I was bankrupt many times over.
Okay. Just your thought, Martin, on the banks. Do they look fragile and expensive? Would you be staying clear of the majors?
I think the fear, I mean, the market's obviously a bit of a weighing machine, right? So at the moment, it's focused on a downturn in housing, which we've been talking about forever, which is, arguably never going to happen. It's now around capital. So Wayne Byers come out with this unquestionably strong statement. APRA's getting close to clarifying what that means and clarifying how much capital the banks need. So the brokers are all running around again this morning and yesterday saying, right, we think the banks need to raise more capital. ANZ's got the best capital ratios. It's performing the best today. So we're sort of switching back to that sort of whole capital thing. But as Westpac just showed, they've got a fund management business they don't need. They've just raised 600 million selling that. ANZ's selling its funds management or wealth management business. It's easy for Commonwealth CBA to sell their wealth management business. So they've all got assets they can sell to raise capital. So the banks are actually starting to look interesting. They're not quite at levels that we'd be backing the truck up, but they're certainly getting close. The TSR of the bank sector is about 13% at the moment. We look for 15 to 20 before we get excited, but it's certainly looking a lot better value than it has been in the past few weeks. I mean, as I said, Westpac are off almost 20% off their highs.
Okay. Chris, I just want to get back to you. Look, we talk about, this lack of volatility, I suppose, and questions about these high valuations. Are there still places to go, though, in this environment? What sort of portfolio are you running at the moment?
Yeah, look, Leanne, I come from the perspective of a trader as opposed to the guys that are sitting on the desk there with you. So right now I'm running a neutral portfolio. We've got 2 longs and 2 shorts. And, you know, I've heard some guys on the show earlier today say it's absolutely a stock picker's market. So I'm looking at themes. You know, iron ore is an obvious one right now, getting absolutely trashed. So the likes of Fortescue, Rio, and to a lesser extent BHP are a bit on the nose. So there's a short play there. Again, a short-term opportunity that you can take advantage of. Looking on the other side, you know, there's something like a CSL, which is, you know, probably the most well-run company in Australia. They've got a couple of promising things happening with their drugs. One drug that is just shown some promising results, and another one, their Haegarda drug, which is expected to be started selling in the US in the second half of 2018. So some things that might move the needle there. So, you know, as I said, what it rotates to and what I pivot back to is it is a stock picker's market for me as a trader, and looking for those dominant themes where, you know, you can shave out 5 or 10% and move on to the next play.
All right, excellent. Very quickly, Chris, and I'll come back to you in a moment. We're just seeing some news on the bottom of the screen at the moment. This is in regards to the New Zealand budget, which has just come through. Just to take viewers across this, the government expecting to post a bigger than a forecast budget surplus in 2017. It's planning to invest the extra cash in infrastructure to fuel the growing economy. The government predicting a $1.62 billion surplus, that's New Zealand dollars, of course, in the year to June versus the prior forecast of $473 million surplus in the December half-year economic and fiscal update. So you can just see some live shots at the moment. The Finance Minister there, Stephen Joyce, delivering that budget there into Parliament. Let's get back to our market though, and we'll bring back in Chris Conway, who's down in Melbourne for us. And Chris, I wanted to ask you about Automotive Holdings there today. Now they've warned this morning of a softer update there in terms of, you know, their Western Australian market tightening conditions, consumer credit conditions and so forth. Has this come as a surprise? What did you make of that announcement from AHG today?
Yeah, look, it was obviously very bad and it was a bit of a triple whammy. So the Eastern Seaboard had been the strong part of their company, or the Eastern Division had been, you know, really propping up the business. That weakened. Western Australia was already bad and deteriorated, and as you say, credit conditions tightening for people wanting to buy cars. So like I said, a triple whammy. I wouldn't say it was completely unexpected. I might say that the size or the severity of the impact was a little bit unexpected, but look, ultimately it's translated into a 10% whack in the share price, which is probably about right.
Yeah, we are seeing that stock down, about 9.5% for AHG. That's the ticker code there. Before we lose you, I also want to speak about the retailers, because there's some pretty big moves for the retailers today. Myer is among those, of course, news that Topshop Australia is going into voluntary administration. On top of that, we've seen broker moves. JP Morgan coming down, downgrading JB Hi-Fi, Myer, Super Retail and so forth. What are you making of those moves across the retail space today?
Yeah, look, I mean, the hits keep on coming for retailers. I mean, there's the Amazon story in there as well, which is an ongoing factor. So, look, retail is essentially on the nose at the moment. So, I mean, look, just from my perspective, a couple of points. It wasn't so long ago that I was a holder on the long side of JBH, and I am not embarrassed to say it was probably only good fortune that I got out of that trade before it really bit the dust and fell sharply. I have been on record consistently saying, though, that Myer as a business I think is dead if it continues to operate in its current form. Throwing $500 million at refurbishing their stores is going to do absolutely nothing to increase sales or move the needle there. So Myer, I think, like I said, I think that business is, if not dead, dying and well on the way to potentially becoming extinct. Solomon Lew or no Solomon Lew. You know, I don't think he's the type of person, particularly at his age, that wants to fight that fight and try and rebuild it. Probably a blocking stake if he's going to do anything, and then he can do the same thing that he did with Country Roads. So, look, overall, some problems and some heat on the retailers, and that's a theme that I wouldn't expect to change anytime soon. Yeah,
certainly showing a lot of volatility, Martin, not just the Amazon threat, as Chris rightly points out. I mean, you've got excessive household debt, which seems to be, you know, reigning in consumer spending. That obviously having a flow through to those retailers.
Yeah, there's not a lot of good news out there, is it? But, I mean, Rudy and I were talking before the show about, you know, capitulation, and we saw this a year ago with iron ore companies, and there was a race to the bottom and everyone was trying to cut their forecasts and cut their target prices and be the most bearish on a sector that everyone's already bearish on. So is there any news in what JP Morgan have written? No, they're just saying, oh, Amazon's coming, consumers are weak, wages growth is tough, there's a bit of credit tightening going on, so it's terrible for retailers. But it's in the price though. You look at where JB Hi-Fi and Harvey Norman are trading at, they're trading at 11, 12 times earnings. The rest of the market, ex the banks and resources, is probably 17 or 18. So they're already a third cheaper than the market. So there's pretty bad news already factored in. I think the next trade is to the upside, not the downside from those retailers.
Yeah, right. Are you bearish on the sector?
That's an interesting call he's making there. I do think there's many aspects here, and I, in all fairness, saying that I've stayed away from retailers a long time now for the reasons that are now coming to the fore. My view has always been, what if house prices in Australia all of a sudden are no longer going up? And that's what we are going to experience now. And then you will see that consumer spending will take a hit here.
Yep.
Every modern economy is 50% or even more consumer spending. So it's very difficult to completely erase that exposure if you're on the share market. But there are ways of having direct exposure and indirect exposure. Right? I haven't gone into the retailers, and they will have a tough battle at their hands. Goes without saying, they're all being sold out without discretion. There's no difference between the good and the bad ones here, and there's no doubt that at some stage the good ones will come to the fore. The difficulty now is predicting which ones will the last one standing up and which one will be rightfully sold off. And I think you have to have some balls here. And you have to have patience, and you have to have a character in withstanding short-term pressure on the share price. And I'm pretty certain that that's a difficult task for everyone, especially if it's your own money.
Yeah, certainly. Okay, well, we'll delve into some more detail on those retail stocks and Maya a little later. Chris, we will have to leave it there, but it's been great having you on as always. Thanks very much for joining us.
Cheers, guys. Thank you.
Chris Conway there from the Australian Stock Report.